Hello, everyone, and welcome to this episode of The Fat Pitch. I'm your host, as always, Paul Borowski, and I'm joined by my co-host, Clint Sorensen. Clint, it's been a little while since we've been able to have a guest. Why don't you tell everyone who joined us today?
Oh, man, I'm really excited about this. We had Luke. Luke, thanks for joining us again. We had you on last year. We talked about carbon markets. Really excited to get you on this year. So we have Luke Oliver. Luke, his accent is not where my accent's from, so he's not a North Carolina native and doesn't get to eat North Carolina barbecue like I do. But he's very bright, knows all things about carbon markets, energy, commodities. He's just a phenomenal mind, and I'm really excited to have you on the podcast. So, Luke, tell our audience a little bit about yourself, and let's get this thing kicked off.
Yeah, well, thank you, Clint. Thank you, Paul. Different accent. I'm from London originally, but I've been in New York for about 20 years. So and I became an American citizen in January or February. So I'm fully on side now. So I work at KraneShares. We manage, and specifically my role at KraneShares is I head the climate business, which is about 10% of our assets. We're a $10 billion asset manager and, focus on China, emerging markets, emerging technology. But where I focus is where that technology meets the energy transition and where carbon markets make up probably the lion's share of those assets. So we manage about $600-700 million in climate carbon assets. And this is an asset class that if you haven't heard about it yet, and hopefully you did last year when me and Clint first got together on it, but it's very much emerging now or landing with investors. We're seeing a lot of family offices, a lot of endowments in particular, really engaging with carbon markets. And this is an investment first and then climate adjacent second. So I always like to get that out of the way up front because often people kind of think, oh, is this ESG? And I'm sure we'll talk about that. But this is an investment, and this is an investment that fits very solidly in a portfolio.
Yeah. So how does that occur? How do you differentiate so that, I guess I would use the term, the climate tail's not wagging the investment dog, but the other way around?
Yeah, very nicely put. I haven't heard it like that. I come up across this every single day, and it's a 50-50 almost, whereby some people have, teed up the meeting with we're an ESG investor or an impact sustainable investor. The other half, I almost think sometimes it's a trap and they want to get an ESG person in the room to beat up. And the reality is it fits both sides because it actually runs straight down the middle. This is an investment. It doesn't matter what your view on ESG is. This does not have any ESG label on it. This is an investment in compliance carbon markets, which are government regulated price on carbon. And what I tell investors, and this seems to resonate on both sides of the coin, is that this is first about investment. Secondly, regardless of what you believe, what you like, what you don't like, what you believe and don't believe, one thing is absolutely true that is not up for discussion because we all know it's true and see it every single day. That is government policy in all major Western governments and spending in all major Western governments is aligned to decarbonizing. Now, you can tie that into the climate because I think it's very key. And for us, we've looked and studied, carbon concentrations in the atmosphere, the correlations of that increase, albeit quite small relative, carbon is only about 400 parts per million in the atmosphere. But I've been working, some people say, how can that make any difference? Well, a tiny drop of cyanide in your milk can be quite fatal. And so, a small amount of something can still be pretty catastrophic. And so we understand the science and the challenges around the climate side of things. But realistically, what this is about is low cost, renewable. When you hear renewable, think infinite. So low cost, infinite technology is the goal. This is the goal of human civilization for as long as we can remember. We need more energy. Energy consumption is going exponential, and we need to do it in a very sustainable, reliable way. And that's why every government is in this arms race to be the owner and the leader in that renewable, low-cost energy. So coal and gas have their place. They'll still have their place for some time. But if you kind of pivot from thinking, oh, they're trying to kill the energy companies, these green lobbyists, to we're trying to create complete energy independence and be the leading country in renewable and low-cost scaled energy, it kind of puts it on its head a little bit. And that's what this is about. And that's why You've got, if you think about policy, it's carbon markets, and we're going to talk about that. On the spending side, it's the Inflation Reduction Act. And China is spending almost as much as the whole Inflation Reduction Act every year on renewables. Europe is spending about 288 billion every year on the same. We're in a race for that technology, and having a robust carbon market accelerates and catalyzes that innovation in your economy. So you can look at this with a pure capitalist hat on and say, I'm not interested in the climate. I'm interested in innovation and the catalyst and being on the side of government policy and government spending, because like it or not, that's where the dollars are going. So that's how I reconcile it. And I say that to both groups, and they get it. And then some people say, well, and it's having incredible impact on the climate. And I say, yeah, that's also true. So that's how we come about it. And I also find that a lot of states that some people would think would not look at something like this, like Texas, know more about this than anybody else, because they trade power and gas and they trade energy markets. And this is part of those energy markets. So long answer, but I can't say this enough. I'm not asking you to listen to me to tell you about something nice you can do with your money. This is an investment. It's also going to be a very powerful catalyst for reducing the amount of carbon in the atmosphere.
Luke, it sounds almost like a commodity of sorts, right? It's you just laid out a perfect case for this rising government wave of demand, right? And then you start to think about the supply constraints and just in terms of energy consumption. I mean, even AI, I always talk about this a lot with friends and colleagues. Everyone's so, bulled up on AI, which great, it's changing the world, but the energy consumption that's going to require, ultimately, you have to get back to energy consumption, and cheap, renewable, or like you said, infinite sources of energy is really the goal. So walk me through, what are carbon allowances, right? If you think about this, it looks to me like, or it sounds to me like commodity of sorts, right? There's supply, there's demand. I can make the investment case based on those two things. But walk me through the fundamentals of what are carbon allowances.
Yeah. And there's something very interesting here. They are like commodities in lots of ways. They're also absolutely nothing like commodities in one very vital way, which is they should be priced, and this is where the opportunity comes from. They should price like financials, because the difference between a financial asset and a commodity is the commodity is physical. It's expensive to pull out of the ground. It's expensive to transport. And so the price of commodities is always clearing where supply and demand is today. And the market is trying to price out a futures curve, whether it's different harvests, different OPEC statements, whatever it may be. In the carbon markets is one source of primary liquidity. These are government issued. Secondly, they don't go bad. They're free to store. It's an electronic record in your account. And so for that reason, it should price like a financial. But what we see is this very clear financial valuation and trajectory that is incredibly attractive. So I'll give the punchline away. We're talking about potential 100, 200% returns by 2030 in this market. So incredible upside, but yet they're not pricing efficiently today. We're still getting periods of sell-off, even though everybody agrees they're going to be 100% plus higher in 5 years. There are still people willing to go short because they see these short-term drivers, and it's creating a lot of opportunity for the patient long-term investor. So you say, what are they? Well, I got to be careful with my compliance work, but I don't want to, it's almost like a perfect storm of a product, because any good market has robust framework and regulation to make it transparent, clear, robust, but then it is free for the market to price. And I think, the New York Stock Exchange, everyone always says that's the home of capitalism. It's also one of the most heavily regulated, red tape, saturated places on earth. And that's good. That's a good thing. It has all the laws and regulations to protect us. And then it's our risk to play in that market. And so carbon is just like that. So carbon, not to be confused with what's called the voluntary carbon markets, which is where people are doing forestry projects. We're not talking about that at all. It's not just forestry, but let's put all of that aside. If you hear about voluntary carbon, carbon credits, carbon offsets, we're not talking about that today. We are talking about what we call compliance carbon allowances. This is a $900 billion market. The other one is about a $2 billion market. This is massive. This is a massive institutional market. So what are they? So carbon allowances are where governments, and the four big markets that we look at are Europe, the state of California, so, fifth largest economy in the world, the northeast of the US. It's a program called RGGI, and it's, imagine New York, Massachusetts, Maine, Virginia, whole eastern sea, northeast of the US, their power generation. And the fourth one is UK, so Europe, California, UK, and RGGI. And these markets are growing. I mean, at the moment, they cover 23% of global emissions, but China, South Korea, Japan, Australia, New Zealand have all introduced programs like this. So they're growing. But what they do is they set a number of allowances that they auction every year. And then by law, if you are polluting within that economy, so if you have a factory that emits carbon dioxide, you have to measure that in the same way we measure our income for our taxes. They measure that, and then they have to deliver one credit for every ton of carbon that they emit. And so what happens is they auction these credits, and in the early years, they auction more than they need. They're very generous. The price is low. The auctions allow all of these companies to buy as many as they need and to put on hedges for the future. And then over time, they say, right, our target is a 40% reduction in carbon emissions in Europe. So all they do is set the cap on how many they auction every year to amortize down to a 40% reduction. And that means by 2030 and by 2050, at the various different milestones, they're only going to give out and only sell enough permits to that level. Now, what's great about that is it doesn't mean you force anyone to do anything. People can keep polluting, but their cost is presumably going to rise as these become more scarce. Any smart company does not want to have to pay taxes, and they don't want to pay for carbon allowances. So it's simple. Find easier way to do things. So that's how it works. They basically reduce the amount that they sell.
So they're really controlling the supply significantly. Knowing there's this wall of demand, they're controlling the supply aspect. And and that helps because it increases the cost of compliance. So it incentivizes firms to aggressively buy these allowances on the front end.
Correct. It makes them buy them, makes them hedge with them. Now, most of these companies will say, we'll buy them when we need them. And each year they go and buy some, and you'd get a very seasonal curve. But why this market is so dynamic is it allows speculators, and that sounds like a bad word sometimes in certain circles, but speculators are part of the market. You have hedgers and you have speculators. And the speculator's job is to create price discovery. And that's our job. And we see in both of these major markets, Europe and California, that they are undervalued relative to their fundamentals, relative to the demand-supply imbalances that we see in the future. So a little bit like a commodity, as you said. And we know that if these were priced based on their fundamentals, they'd be much more expensive. And so as speculators, it's our job to buy them and to profit from that rise when they correct to the correct price. And when that happens, three really amazing things happen. This is the impact side. You get this massive revenue. So also, it's not like a tax because you can hedge it. Imagine you could hedge your taxes and lock in your income from 2 years ago and then grow your income without, it's fascinating how it favors innovation. It favors taking risk and being forward thinking about managing your carbon emissions. But you get this massive revenue from the government that they then put into various programs, such as, direct impact, so helping lower income families, saving wetlands, converting municipal buses from diesel to electric or hybrid. All of these programs, you have this war chest that goes towards these programs. Secondly, you get fuel switching. If you're a company and you have a very simple, you can change your filters, you can change a few small changes in your factory to make it pollute less, you'll just go and do that now because it's free money. You can save on your allowances. When polluting was free, you just didn't bother doing it. So we have this sudden, great, just very quick overnight improvement because it matters. Any CEO, any shareholder, any CFO is going to say, guys, let's spend a little money on these things, our carbon footprint, because it's going to save us money. So you're putting capitalism into the problem. And then thirdly, and this is the exciting part, is you have all of these innovators that if someone invented a carbon capture machine 20 years ago, they would have got, an award for cool invention, but they wouldn't have got any funding because there's no money in it.
Yeah.
Today, companies are going to say, you have an invention that can reduce my carbon bill. I'll pay 10 million for it because I'll monetize that over the next couple of years. And then I'll be, making huge strides. And then all of a sudden you scale that technology and it becomes cheaper per unit. So it's a huge driver for innovation. That's how I see this more than anything, more than a tax. I see this as an innovator. And I also see, don't fight the Fed. there's a tightening forecast between now and 2030 and then 2030 to 2050. And we get to be long that asset.
Will you give me an idea, since I'm relatively new to this, what's the overall size of this market, if you can? Kind of give us, I think a lot of people would be curious.
Yeah. So between the auctions in the primary asset and the futures markets that we track, and we're only tracking the four majors, it's about $1 trillion, probably about $900 billion. So this is
what was it maybe a decade ago, and what do you expect it to grow to?
Yeah. So it's interesting. I think we're starting to get to critical mass in these in the major markets as they start. So if I think we could increase by 100% over the next few years, then I think it can double. Yeah. But 10 years ago, it was much smaller. I usually look at sort of 5 years ago, it was in the low hundreds of millions. Okay. So it's grown pretty exponentially. Every year over the last sort of 5 years, and we think it continues to grow. And then at some point it kind of matures because two things happen. The number of credits, as we bring down pollution, we start to have a smaller base, but a much higher price. So it starts to change over time. But between, we're in 2024, between now and 2030 is going to be the exciting time. That's when investors really can benefit most from this. But it doesn't stop. It goes on through 2030 onto, towards 2050. But I think if we get this right, the lion's share of the returns will be captured in the next 5 or 6 years. But to your point, it's a huge market. I mean, California is about 65 billion every year. And that's the UK similar. And then Europe is the big one. Europe is like over 600 billion in itself. And so Europe is by far the biggest. But where it gets interesting is China is an even bigger market than Europe in terms of its pollution footprint and the size of the market, but its trading volumes are low. So Europe still holds up as the biggest market. And when I say, so it's a little bit like talking about liquidity versus market cap. China's the biggest in market cap, if there's such a phrase for carbon markets. But in terms of liquidity, it's Europe, followed closely by California and UK. So the top line number I use is we're pushing towards $1 trillion in trading. And so this is by no means a niche corner of the world. This is a real market.
Yeah, and that's significant.
Yeah.
Okay, so it's a great investment. You just laid out the case for pretty exceptional returns. How should an investor or an allocator look at this asset? Where does it fit in a portfolio, right? From a risk correlation perspective, what work have you guys done from a portfolio management perspective or portfolio construction perspective?
Yeah.
As far as this asset is concerned.
And at some point, I'd love to show people I've got a couple of price models that we can get to, but let me answer your question.
Yeah. Tell me when you want me to put those up.
Yeah. So when you think about this in a portfolio, it's interesting. At times I go to pains to explain to people why it's not a commodity, because there's a lot of challenges with like the price of holding. You could be right about the direction of a commodity and still get it wrong because of the cost of being long, the cost of rolling the futures. Carbon is not like that. Despite some rumors to the contrary, carbon, its curve, because it's it's the futures curve. So if I buy 1 year carbon, it's going to cost about 5%. Now you think, well, that seems very expensive, but that's only because the futures market is naturally levered. And so you're borrowing at the risk-free rate, right? So that's all that is. Because we're not levered in our fund, we're able to, so if you give us $100, Clint or Paul, I will buy $100 of carbon, but I only need to put up $10 of margin for that. The other $90, I can go and get the risk-free rate. So we actually flatten that curve. So optically, some people say, but that futures curve is 5% contangoed. And I say, yeah, it is. But that's for people that are levered. We're not levered. So we earn back 90% of the risk-free rate in the money markets. So all of that is to say, in our fund, we're unlevered. So we don't really experience the majority of that contango. And you're just getting a pure play, for the most part, on the carbon. So that means that you can be long and long for 5 years in carbon. Whereas with natural gas, that's not a nightmare. You can't do that. So no trading, right? This is a long-term position. You can put this on, and you can put this where you have. So then I flip this around and say, but where does it go? Well, wherever you put commodities, wherever you put thematic, wherever you have carved out space for that diversified return stream. So think about the three things.
So knowing that, and you're a manager of it, who would primary investors be out there? Which type of institutions, which type of individuals do you see right now as the cohorts to allocate to this?
Yeah, well, we see some of the first investors were foundations that had been looking at this exposure in the private space. And then when we launched the ETFs, they were like, wow, you've just simplified this whole thing. So we had a very early rush of institutions, foundations, endowments that were looking for this exposure. And they were thinking that, and they were pretty ahead. I mean, I was surprised at how far ahead they were in terms of research, because they came to us saying, like, I mean, they didn't use these words, these are my words, but, we came for the impact, but we stayed for the return and correlation benefits. And so that was our early first wave. The second wave were, the single family offices. They were all out there exploring carbon markets. So pretty much anyone willing to look at interesting, ahead of their time, sort of avant-garde investments have been looking at this for 2 or 3 years at this point and investing. At this point, we're starting to see the more sort of forward-looking RIAs starting to get invested. We've recently been added to some of the, I won't say their names, but some of the bigger wealth management platforms. So we're starting to see more advisors starting to put these on. So it's really exciting. And I think
that's exciting. That's really exciting. Congratulations for that. Because
thank you.
I go back a few years ago as, I just left one of the largest firms in the country 5 minutes ago, I won't mention. And even 5 years ago, you would have never seen something like that on their investment platform. So that says a lot about, and that was the genesis of my question. How prevalent are we becoming, and where I imagine where you hope to see yourself 5 years from now too? So
what I tell people, and it's the same thing I told people 10 years ago when we launched the first currency hedged ETFs at my former firm, was that you tell this story. We told the currency story and we're telling the carbon story today. And people would say, yeah, but you know what? I've lived without this for 20 years. Why do I need this now? And I say to them, unfortunately, you don't have the luxury to think that. You're already in the carbon markets. Every stock you hold is either paying this price of carbon already and is exposed to it rising, so you're on the short end, or they've made commitments to decarbonize. And so you are inherently short carbon transition. You have that risk. Now, you will have some companies that innovate and have successes. So keep your equities diversified, stay in those energy names, because those are some of the biggest spenders in this area. So don't make any rash decisions with your equities, but know that you're sort of short carbon. So if you like what I'm saying, you don't get to choose to say, it sounds good, but I don't want to add that. You're in it, but you're short. And so we've kind of done a back of an envelope that if you take the carbon footprint of the S&P 500, of the emerging market benchmark, you sort of need about 4 or 5%, give or take, allocation to carbon to kind of neutralize that. Now, it's not perfect, right? Because, a company not in one of these markets doesn't have to pay these particular prices. But just generally, carbon footprint divided by sort of a global price of carbon puts you in that sort of 4 to 5%. So you really should be looking at this. And I see this, and I think this is your audience, guys, is this is a way for an investor to make an allocation in that sort of 4 or 5% space that has incredibly low correlations. It has an above average expected return based on everything that I'm going to walk us through in a second. And it does have higher volatility, but because of that low correlation, it actually brings down the volatility of the portfolio. Mm-hmm. So to your question, Clint, we just use like a 5%, 10%. And in every scenario where we put carbon in, we shift that curve, the efficient frontier out and to the left. And then when we compare it to commodities, it's actually significantly better, because obviously over time, commodities don't really give you a return. They're inflation protectors. They move in cycles. We are on one big cycle. So it's pretty exciting. So we think, put it in wherever you have thematic. You can use it as, some people use it as an inflation hedge, because the design of the programs, especially California, is to ensure that it moves by 5%. It has a 5% plus CPI adjustment every single year. So it's got an explicit inflation hedge built into it. So we see that. And then, so where you have alternatives, where you have thematic. And then I also like this idea, kind of touching on, and we hear this less, but we're hearing it more and more, is people thinking about this as an overlay on their equities, as this sort of hedge. So I don't want to sell energy companies because they're polluters. I do want to sell them because they're polluters, but I know that's not a wise investment decision. So how do I do that? put a carbon overlay, and you can do that with these ETFs. KRBN is our global. It's got all four markets in it. And then we have a Europe only, KEUA, and a California only, KCCA. But it's definitely, statistically based on historical numbers, it's very additive to a portfolio because, like I said, correlation to equities, about 0.3. Volatility, about double that of equities. But as I've said, it actually smooths out your volatility at portfolio level. And then in terms of returns, the returns have been very strong since inception in KRBN. I think it's returned about 20% a year.
So that's the IRR?
Give or take, it is. But what we expect going forward, I'll give you some numbers.
Do you want me to throw up the pricing model?
Yeah.
This is so fascinating to me. I'm Clint knows. So, Luke, I always say I was in the half of the class that made the top half possible. I never thought I'd get this far in my career where I'd be thinking allocations to carbon, where does it fit in an overall structure in a portfolio? So really appreciate you sharing this information today. It's quite unique.
Thank you so much for having me on. I mean, you can tell I love talking about this, and it is fascinating. I mean, electric cars and microchips and carbon is big topics of discussion at the moment. It's a world away from where we were 20 years ago. But so what this shows is this is the European market, and we have. So I'm going to go back just one step. European carbon is currently trading at about 62 euros a ton. Prior to the Ukraine invasion, it was trading at 80 to 100. So we've had this incredible return, but we've really pulled back. All of the forecasts get you into the 120, 140 by 2030. California, on the other hand, is trading about $40 a ton, and all the forecasts by 2030 are around $100 a ton. So both of these markets have a 2 or 3x between now and 2030, according to most forecasts. Our forecasts and our research say something very similar. And this is why, and I mentioned at the beginning, there are people trading this more short-term, and then there are the long-term investors. And the rewards here are for the long-term investor who can wait, doesn't mind a bit of volatility on the way. And as I said, because the correlations are low, it actually doesn't feel that volatile in your portfolio. There are those incredible potential upsides that I'm talking about. So listen, just look at that. Check this out, right? So the purple line, the top line, is them reducing the cap. That's the cap going down. So that is your sort of tightening policy. The black line is the surplus in the market. So you remember I said the way they work is they auction more than they need, and then they tighten the screws until they get to their target. And eventually the market will either buy them at the auction, or they'll use their hedges or their inventory. And it's only when that inventory starts getting tight, the rubber hits the road and the price starts to move. So what happened here, and I know this might be a little technical, but I think anyone who sort of thinks about pricing and I think this will be intuitive. So if you look at the black line was reducing, and it was previously more like the dotted line. It was a more linear slope down, and that's why we saw prices going up. And that's why we see the price ultimately, as you see by 2030, that surplus is almost gone, if not completely gone by 2030. So we are going to see incredible tightening in the price between now and 2030. However, because of the Ukraine invasion, it was a very good policy, and it shouldn't have really done much to the price because they got it right. But of course, short-term traders and long-term investors approach this very differently. So what happened was they front-loaded the auctions. They said in 2023, 24, and 25, we'll auction an extra 6%, give or take. And then in years 27, 26, 27, and 28, we'll auction 6 to 8% less to account for that. So in theory, that was totally neutral. But what that looked like, if you were a shorter-term investor or trader in these markets, is you would say, well, that means instead of that linear line of tightening, it actually flattens in the first 3 years and then double tightens in the second 3 years. And so as a financial investor, we said, this is not news. The net of this is essentially the same thing. We're very happy being long. And we have I don't know if it's the slide prior or if we even have it in these slides, but there's the longs and shorts. And maybe I didn't know. So we can go back. There was basically all the long holders stayed long. But all the short-term traders that flip long and short have all gone short, and the market net went short in the futures. And so in this flattening that you can see in the circle, instead of the market slowing down its rally, it actually sold off. And it's kind of logical for some of us, if you think about sort of technicals, that we flattened relative to expectations, therefore we sold off. But it's not entirely rational for something as long-term as carbon. So we've been in this sell-off. So all of that is to say, while we're in that circle, we have an incredible buying opportunity. Everyone that is short this market in the futures, they believe that we're going 100% up as soon as this line rolls over. But they're just positioning short-term. They're trying to make a buck on the downside, and then they're going to flip to long. We think this is the place just to be long. Let that volatility happen and just take this upside. So right now, we've seen the market sell off. Down. If we go to the next slide, so you can see here it rolls over at the end of this year. Here, all of these forecasts have not changed. All of these analysts, ourselves included, put the 2020-30 price at well over 100. You can see there 146 euros from Macquarie, ISIS at 106, 140 for energy aspects, even higher from Vate. All of these guys see this price significantly higher. Today, you can buy it at 62 euros, and we think that it's going to price in sooner rather than later. So we were very bullish at 90 because we saw it going to 150. We're now down at 62. 62 to 150 is very compelling. Now, some people will say, well, is there a way to de-risk this further? Well, yeah, you can combine a bunch of different versions of this story that don't correlate with each other and make that even more robust. So right now we see, I mean, even if you look at Macquarie, they think by the end of 2025, it'll be 93 euros. In fact, all of those numbers, 50, 77, 76, 91, we're trading at 62 right now. So they see a lot of this return happening in the next year. We're saying the same thing. We're saying that we're talking about the next 6 to 18 months is when we're going to see this get back into the 80 to 100 range, and then onwards to 2030 on these higher numbers. So, more than based on these numbers from the 62 euros today, you've got more than 100% upside on most of these forecasts between now and 2030. California is really interesting.
So what about these other markets, right? So that was Europe. What about this one on California?
Yeah. California and some of the Canadian programs that are intertwined. This one is even cleaner. The same purple line shows the tightening. It gets a little steeper after 2024 because of the new tightening measures that they've announced. And you can see that surplus, Europe's surplus has always been trending down. It's just whether it's trending down fast enough. California's has been growing, and we're at the inflection point where from this year on, it's no longer growing, it's tightening. And that's why California was up 34% last year, because the market finally said we're rolling over.
So that goes to your point, Luke, about having multiple of these in a portfolio, right? Because you just talked about Europe, not going up last year, actually going down, whereas
smoothing out the lines for the diversification play.
Yeah. Classic diversification. And we have 4 markets. Now, Europe and California really drive. We're sort of 60% Europe, 30% in this market. But we have a fund just for Europe, and we have a fund just for this as well. So a lot of people are buying the global and then adding some extra California. That's kind of...
Yeah, and then you can overweight. So you can buy a diversified portfolio and then take the market you like and overweight that individual one.
Correct. And that's been quite popular. And that's why we're actually seeing, we used to be predominantly in the global, and now we're seeing the globals come down, and we've seen a lot of assets go into the California.
Couple of random questions from me, and Clinton, as I always have these oddball ones the hamsters are running in the wheel. Personally, or as a company, do you have an outlook on cheap nuclear power?
No, is the short answer. I'd love to. I'd love to get into it a little more. I mean, there's so much political baggage around that. The argument is that as this price rises, you get even more investment into fusion. That's why I was asking. You read my mind. Yeah, I kind of joke sometimes. Again, this is when I'm trying to get people sort of off the, left liberal program. And it's not. This is
the tree hugging fun.
Yeah. When I'm trying to convince people, it's not that. I say, look, we all want energy. We all want everything that we have, and we want it to be cheap. And we're still out there burning coal these rocks that we dig out of the ground. Like, what are we thinking? Like, that's all it is. Like, why did we, and again, I don't want to offend anyone in Pennsylvania, Lancaster County or wherever it is, but like, the Amish for some reason picked some year in the 1800s and that's it. That's where they're going to live. Why did we decide that we're going to live with coal and oil and gas and like ignore all the other technology that we've invented? We've invented scale. Think about it, right? We've got nuclear, we've got solar, we got wind, we've got geothermal, we've got hydro. The list goes on. We've invented them, but they're not scaled right yet. We haven't yet scaled them with the right investment. And you could argue, lots of reasons why that is. But putting a price on carbon and then creating government spending incentives is we're going to find out. We're going to find out which one of these is the one that can be scaled to be cheap coal and gas. And then once that happens, and, CERAWeek was in Texas a couple of weeks ago. It used to be, the energy conference. Now it's the energy transition conference. All the energy companies are on board with this. We don't have to worry about the energy companies. They're going to be fine. This is their time to shine. And so we're going to find out which one of these technologies scales fastest and best. And it's going to be the one we're going to use. And that's it. And it might be a combination of 3 or 4 of them.
All right. So in our last few minutes, Luke, let's sum up. The fat pitch is obviously carbon markets. How would you advise our audience to take advantage of the opportunity today, and why now? Right.
In other words, what's the fat pitch?
Here's the fat pitch. And before I give you that, just look at this chart. This is the California market with the little squiggly line at the bottom there, not the very bottom, the one in the sort of between the blue and the orange line. That's the current price. It's trading at $40 a ton. The bottom line is the market floor. If it trades below there, they stop auctions. So the supply disappears if it goes below there. Therefore, it can't trade below there. So that's your floor. By 2030, and remember, all of these lines go up by CPI plus 5. So that bottom line goes up to about 39 by 2030. And when you buy it today, you're buying at 40. So if you're holding between now and 2030, your downside is almost completely protected by that market floor. The orange line is actually where it should be trading today, because if you remember on that curve I showed earlier, the surplus runs out by 2029. So we're going to have to trade at the first liquidity tier. That first liquidity tier is at $56 today and will be at $88 by 2030. The market forecasts then that today, that $40 investment should be at 56. So it's 35% right there. And then by 2040, most market participants think that we will exhaust the first liquidity tier and be at the second liquidity tier, which is the yellow line, which is trading at about 115 by 2030. And then even California, the state of California, who run the program, are expecting by 2035, it should be 145. My personal forecast is that chart on the left. And by 2030, I think it will be 150. So a little bit different. I think $150 by 2030 or just thereafter. The state of California says 145 by 2035. So not that different. But again, the run that we're going to have from today to 2030 is going to be the lion's share of this, the exciting part of this. So the fat pitch is that you should be adding carbon to your portfolio, carbon compliance. And the very simple way to do that is to use one of our ETFs. KRBN is our global blended, 60% Europe, 30% California, 5% each UK and Northeast US. And with that, you get a 0.3, which is very low correlation to equities. You get an expected return that we've just talked about that could be well over 100 to 200% between now and 2030. And you also, if it's something you're interested in, you're actually creating the price discovery that is going to be one of the biggest catalysts for innovation and investment in clean technology. So really, this is something that gives you everything that you would like from an alternative investment, while also being arguably the purest play on having impact.
I love it. It's a very different way of looking at things. And I think with all of the backlash on ESG or green investing recently, I mean, I heard it a couple of years ago at University of Chicago about if you want to pay a green tax for your investment return, it depends how much. And I said, I hate UBTI. I might hate the green tax more. Yeah. So this was really enlightening for me. Clint, you probably, you've known Luke a while. Anything to take us out here?
No, Luke,
Yeah,
just thank
definitely.
you. I know our audience is going to really appreciate this. And how can people get in touch with you, Luke? So
You got
people
a
have
Twitter?
questions.
I've got it. It's Twitter is Luke A for Anthony Oliver. And also KraneShares.com. You'll find us there. info@KraneShares.com or luke.oliver@KraneShares.com.
Cool.
Please look us up, and we happy to go through all of this.
Yeah, one last question before we go. Clint knows I get really intellectually curious about new subjects. Is there some place, maybe you link to them a lot on Twitter, but if somebody wants to learn more about this, is like following your Twitter a good way? Do you sometimes link to articles, or are there other publications or sites that you look at in this area?
I'll get better at Twitter, I promise, but we write a blog every single week. And we write an article every month, and every quarter we put out a complete quarterly report on this market. No one puts out more on this than we do.
That's fantastic. Because Clint or Luke, you said it earlier. I think about the burgeoning RIA space. There was nothing. So I think advisors that watch us or that we talk to, investors, thanks for that. Your blog's probably a great place for info. Yep. So very much appreciate you. Very different fat pitch than most things we heard. I'm going to ask one non-financial question before we go.
Go ahead.
Are you going to, like me, when this is over, turn on the Arsenal Champions League match and cheer for my Gunners?
No, sadly not. I grew up liking Chelsea as a kid when they were they were terrible, and then they got very good, and I was kind of a phony because they.
Well, they got very rich for the Abramovich's
They got very rich, and then now they're not so good anymore. What are we, 10th place?
No, they're
so
not.
I'm not. It's not my. It's not my thing, but
not your cup of tea. Well, now you all know what I'm going to do when we end this podcast. So by the time people listen to it, hopefully I'll be happy, Paul.
Oh, it's right now.
Yes, it's on right now, but very shortly, just right now. But listen, on behalf of Clint and myself, thanks everybody. Luke, we can't thank you enough for joining us today. Absolutely fantastic information and very exciting to learn more about. So thanks all.
Thanks, Paul. Thanks, Clint.
Thanks, guys.